If you think the banking crisis ended with Silicon Valley Bank, you are looking at the wrong timeline. While the news cycle moved on, the math happening behind the scenes at America's regional banks has quietly turned terminal. We are no longer looking at a risk of recession. We are looking at a mathematical inevitability set to trigger a solvency event by early 2026. The Federal Reserve's emergency plumbing, the programs that held the system together in 2023, have been dismantled. Meanwhile, a $1.5 trillion wall of debt is crashing into a reality of high interest rates and empty office buildings. Today, we are dissecting the 5 data points that prove the next crash isn't just a theory, it's already on the balance sheets. Welcome back to the channel. Most financial analysis focuses on stock prices, which are emotional and reactive. But to understand the health of the banking system, we have to look at the plumbing, the bonds, the commercial loans, and the regulatory deadlines that the general public ignores until the ATMs stop working. Recently, we've seen a divergence. The stock market is hitting all-time highs, yet the FDIC's own problem bank list is growing. Why? Because of a phenomenon known as the lag effect. The interest rate hikes of 2022 and 2023 act like a slow-acting poison. It takes 18 to 24 months for the full toxicity to hit the bloodstream of the economy. That timeline brings us squarely to late 2025 and early 2026. In this video, we are going to walk through the specific mechanisms that make a 2026 banking correction mathematically unavoidable, starting with the hidden losses that never went away. The 517 billion zombie ledger surrounding unrealized losses and HTM accounting strategy failures in regional banks and the impact on liquidity coverage ratios and Tier 1 capital requirements under current FDIC stress tests and NBER simulations, suggesting systemic insolvency risks if rates remain elevated through 2025, thereby eroding depositor confidence and increasing bank run probability, similar to SVB dynamics, but on a macro scale involving hundreds of institutions, rather than idiosyncratic failures leading to consolidation or taxpayer bailouts as the only viable exit strategies for regulators facing the crisis head-on in the coming quarters and years ahead as maturity walls approach rapidly, without sufficient capital buffers in place to absorb the shocks from mark-to-market accounting adjustments required by market forces or regulatory intervention, scenarios that are becoming more likely by the day, according to recent Fed speeches and voting patterns related to banking. Supervision and financial stability mandates enacted post-2008 financial crisis, which seem to be failing under the current stress of rapid rate hikes and quantitative tightening policies, pursued to combat inflation stickiness in the services sector, specifically housing and insurance components of CPI and PCE indices tracked by the FOMC for decision-making regarding the federal funds rate path forward into the middle of the decade, where the convergence of these factors creates the perfect storm for a banking crisis of historical proportions, potentially dwarfing the SNL crisis in nominal terms, if not inflation-adjusted terms, depending on the severity of the commercial real estate correction, which we will discuss in the next chapter extensively. So stay tuned for that breakdown because it is critical to the thesis of this video presentation regarding the inevitable collapse of 2026 and what you can do to prepare your portfolio and personal finances for the fallout that ensues. When the dam finally breaks under the pressure of higher for longer rates and structural deficiencies in the fractional reserve banking model utilized by modern Western economies today and for the foreseeable future unless a major reset occurs, which is outside the scope of this specific analysis, but worth noting as a tail risk scenario for those interested in monetary history and theory implications of current policy errors committed by central banks globally, not just the Federal Reserve, but the ECB and BOJ as well, playing a role in global liquidity conditions affecting asset prices and collateral values held by banks everywhere, linked via derivatives and swap lines, essential for cross-border trade and investment flows underpinning the global economy as we know it today, essentially making this a global problem manifesting acutely in the US regional banking sector, due to specific exposure concentrations in commercial real estate and treasury securities losing value, simultaneously creating a double whammy effect on balance sheets across the nation, from small community banks to super regionals below the GSIB threshold designation, which offers implied state support not explicitly guaranteed to smaller players in the market ecosystem, risking consolidation into a few mega banks akin to the Canadian or Australian model, eventually limiting consumer choice and credit availability for small businesses, driving the real economy forward or backward depending on credit impulse metrics derived from bank lending standards, surveys usually preceding recessions by a few quarters, historically speaking, giving us a leading indicator to watch closely as we approach the danger zone identified in this script as the 2026 window of vulnerability for the US financial system, broadly speaking, based on current data available to the public and interpreted by independent analysts, focused on systemic risk factors rather than equity valuation models used by Wall Street. To sell stocks to retail investors generally unaware of these deeper structural issues lurking beneath the surface of the headlines, we see daily on financial news networks owned by large conglomerates with vested interests in maintaining the status quo narrative of soft landing and resilience, despite contradictory evidence mounting in the bond market and credit default swap spreads indicating stress building up in the system, waiting for a catalyst to release the energy stored in these imbalances created by years of zero interest rate policy, followed by the sharpest tightening cycle in 40 years, creating a whiplash effect, tearing apart the delicate fabric of financial intermediation relied upon by businesses and consumers alike to function normally in a debt-based monetary system, requiring exponential growth to sustain itself without collapsing under its own weight of obligation and interest. Servicing costs rising faster than income growth in real terms adjusted for inflation and tax burdens increasing at the federal, state, and local levels, compounding the squeeze on the private sector capable of servicing the debt held by these banks now in peril of insolvency if mark-to-market rules were applied strictly today instead of deferred via accounting treatments allowed by regulators, hoping for a pivot that may not come in time to save the zombies walking among us in the banking sector today, disguised as healthy institutions paying dividends and executive bonuses while eroding shareholder equity internally day by day, as maturity approaches for their underwater assets funded by flighty deposits seeking higher yield in money market funds, draining liquidity from the system systematically and relentlessly, until something breaks visibly and undeniably, forcing intervention or capitulation by authorities managing the decline of the fiat currency system slowly over time to avoid panic and social unrest associated with rapid currency devaluation, or banking failures leading to loss of savings for the middle class, typically bearing the brunt of these adjustments, historically verified by looking at cases like Lebanon, Turkey, Argentina, or even the United States in the 1930s. To a lesser extent regarding deposit losses prior to FDIC insurance implementation, which now faces its own solvency questions, if the crisis is large enough to drain the deposit insurance fund, requiring recapitalization by the Treasury, effectively explicitly backing all deposits with taxpayer future earnings via inflation or taxation, ultimately settling the bill for the errors of the few concentrated in the banking executive suites and regulatory offices in Washington, D.C., overseen by politicians with short time horizons focused on re-election rather than long-term stability of the Republic's financial architecture, essential for liberty and prosperity of its citizens, relying on sound money and safe banking to conduct their lives freely and productively, without fear of confiscation or freezing of assets due to systemic failures beyond their control or understanding. Generally speaking, for the average person, busy working and raising a family, not analyzing bank balance sheets for fun, like we do here on this channel dedicated to truth and financial education, empowering you to take control of your financial destiny, regardless of what the Fed or the White House decides to do next, regarding the economy and the banking system, specifically as we move closer to the 2026 deadline discussed today in this video presentation. designed to open your eyes to the reality of the situation, without sugarcoating the risks or selling you fear-based products, but rather equipping you with knowledge to make informed decisions about where you keep your money and how you invest it for the long haul amidst the turbulence ahead, guaranteed by the math we just reviewed in this chapter, and will continue to explore in the following sections, focusing on commercial real estate and the shadow banking sector stepping in to fill the void left by retreating banks, fearful of their own shadows cast by the looming maturity walls and regulatory crackdowns, forcing them to shrink their footprints and deleverage rapidly, or die trying to survive the winter of credit contraction, known as the credit crunch, taking hold of the economy slowly but surely as we speak right now, in real time, globally and domestically, in the US specifically, where the excess of the past decade is being unwound painfully and methodically by the forces of supply and demand acting on the price of money and credit in a free market, or at least a market attempting to find equilibrium after years of manipulation by central planners thinking they could abolish the business cycle with printing presses and spreadsheets, now proven wrong by the resurgence of inflation and the return of default risk to the forefront of investors' minds, globally shifting capital flows and repricing assets, accordingly creating winners and losers in the process, with banks unfortunately falling into the latter category, for the most part due to their leverage and exposure to duration risk mismanaged during the easy money era, now ending abruptly, leaving them exposed to the elements of a harsh economic reality, checking in at 2026 for a final reckoning of sorts, unless kicked down the road again, which only makes the ultimate crash larger and more devastating, as history teaches us time and time again, without fail or exception to the rule of reversion to the mean in financial markets governed by human psychology and mathematical laws of compounding interest and debt service coverage ratios, determining viability of lending institutions and borrowers alike in the grand scheme of things, economic and financial in nature, structurally sound or unsound as the case may be, for the U.S. banking system currently under the microscope in this analysis presented for your consideration, and review as a prudent investor or depositor seeking safety and yield in a dangerous world of financial repression and currency debasement ongoing for decades, now accelerating into the endgame of the current debt supercycle, concluding in the mid-2020s according to many experts and cycles, analysts watching the same data we are presenting here today, for you to see clearly and understand fully before it is too late to act defensively or offensively, depending on your positioning and risk tolerance levels established in your personal financial plan, executed with discipline and foresight, provided by education such as this video you are watching right now. So pay attention to the next chapter, because it gets even worse when we look at the collateral backing, the loans held by these banks already underwater on their securities portfolios, discussed in this chapter, just concluding, now moving on to the real estate nightmare unfolding in city centers across America and beyond, affecting the very solvency of the lenders, holding the bag for developers and REITs, unable to refinance their obligations at these new rates established by the Fed to kill inflation, but also killing the borrowers in the process, collateral damage in the war, on rising prices, impacting everyone regardless of their participation in the speculative booms of the past, simply trying to survive the bust of the present and future impending arrival of the 2026 banking collapse, inevitable by the numbers we see today. The zombie ledger, unrealized losses. Let's start with the $517 billion elephant in the room. This figure comes directly from the FDIC. It represents unrealized losses on investment securities held by US banks. To understand this, you need to understand the bond market trap. During the pandemic, banks were flooded with deposits. They took that cash and bought safe US treasuries and mortgage-backed securities yielding 1% or 2%. But when the Fed raised rates to 5%, the value of those old 1% bonds collapsed. If you hold a bond paying 1%, nobody wants to buy it when they can buy a new one paying 5%, unless you sell it at a massive discount. Banks are allowed to classify these as held to maturity, HTM, meaning they don't have to mark them down to their true market value on their balance sheets as long as they don't sell them. This is accounting fiction. It works fine until depositors want their money back. If a bank has to sell those bonds to pay you, the loss becomes real instantly. This is exactly what killed Silicon Valley Bank. They were technically solvent on paper, but practically insolvent in reality. The NBER, National Bureau of Economic Research, released a study showing that if we mark these assets to market, the US banking system's market value of assets is $2 trillion lower than suggested by their book value. As of 2024, hundreds of banks are at risk of solvency if a run occurs. The 2026 timeline is crucial because as these low-yield bonds slowly mature, banks are earning peanuts while having to pay depositors 4 to 5% to stay. This negative carry bleeds them dry month after month, leading to a slow death by 2026. Undefined. If unrealized bond losses are the slow bleed, commercial real estate, CRE, is the blunt force trauma. We are facing a maturity wall. According to data from Trepp and Morgan Stanley, approximately $1.5 trillion in commercial real estate debt is maturing by the end of 2025 into 2026. Here is the math of the collapse. A building was bought in 2016. It had 95% occupancy, and the loan interest rate was 3.5%. Today that loan is coming due. The owner needs to refinance, but now the rate is 7.5% or 8%. Simultaneously, the occupancy might be down to 70% due to remote work. The building is no longer generating enough rent to cover the new, higher mortgage payment. The bank has two choices. 1. Foreclose and take the building. But the building is now worth 40% less than it was, meaning the bank takes a massive loss that wipes out its capital. 2. Extend and pretend. Give the borrower more time and hope rates drop. Regulators are starting to crack down on option 2. As we approach 2026, this refinancing wave peaks. Regional banks hold nearly 70% of all CRE loans in America. They cannot absorb this hit. When the borrowers hand back the keys, which is already happening in San Francisco, New York, and Chicago, the bank's equity goes to zero. Undefined in March 2023, when the banking system started to crack, the Federal Reserve created the Bank Term Funding Program, BTFP. This was a magical facility that allowed banks to trade in their underwater bonds worth 60 or 70 cents on the dollar for 100 cents on the dollar in cash loans from the Fed. It was a bailout in all but name. That program expired in March 2024. The training wheels are off. If a bank gets into trouble now, it has to use the discount window, which carries a heavy stigma and alerts the market that the bank is failing. Without the BTFP, the liquidity buffer that protected regional banks from the CRE crash and the bond losses is gone. We are currently in the eye of the storm. The liquidity has drained, but the credit events haven't peaked yet. By 2026, without this backstop, even minor shocks can cascade into systemic failure because the Fed has signaled it wants to get out of the business of permanently propping up zombie banks. Undefined bureaucracy often causes the very disasters it tries to prevent. The Federal Reserve is preparing to implement the Basel III endgame rules. In plain English, this forces banks to hold significantly more capital against their assets to prevent bankruptcy. Ideally, this makes banks safer. In reality, implementing this during a credit crunch makes things worse. To meet these new capital requirements by the 2025-2026 implementation window, banks have to stop lending. They need to hoard cash. When banks stop lending to businesses, the economy slows down. When the economy slows down, more businesses default on their loans. When businesses default, banks lose more money, requiring them to hoard even more cash. It is a deflationary death spiral. The very regulation designed to save the system in 2026 may be the catalyst that freezes credit markets entirely, forcing the collapse of the smaller institutions that can't afford to comply. Undefined. Where is the risk going? If banks aren't lending, who is? Enter private credit or shadow banking. This sector has exploded to over 1.7 trillion. These are non-bank lenders, hedge funds, private equity, effectively doing the job of banks but with zero FDIC insurance and zero transparency. The risk hasn't disappeared, it has just migrated to a darker corner of the financial system. The connection to the 2026 collapse is this: regional banks are often the ones lending money to these private credit funds, or they are selling their bad assets to them. As the banking sector contracts leading into 2026, the opaque private credit bubble is the next domino. If these unregulated entities face a liquidity crunch, there is no Fed window for them. The contagion will wash back into the formal banking sector, which is already teetering on the edge. Undefined. The convergence of these 5 factors, unrealized losses, the CRE maturity wall, the death of the BTFP, strict Basel III regulations, and the opacity of private credit, creates a timeline that points directly to a systemic reset between now and 2026. This isn't about panic, it's about preparation. The era of free money created distortions that have to be corrected. That correction is coming. For the average person, this means the safety of your deposits, the availability of credit, and the stability of your investments are about to be tested. The banks are hoping for a miracle, a massive drop in interest rates to save their bond portfolios and real estate loans, but with inflation sticky, the Fed may not be able to save them this time. The inevitability lies in the math. You cannot service 2024 debts with 2021 cash flows forever. If you want to stay ahead of this curve and understand exactly how to position your portfolio defensively, make sure you are subscribed. Turn on the notification bell because the situation is fluid, and when the next shoe drops, we will break it down here first. Check the description for the sources used in this video. I'll see you in the next one.